Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I am your host, Casey Smith, guiding you to financial freedom as my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
Today we have 5 topics that have been floating around the office this week. First one, Wall Street Journal article I sent you. I guess it was over the Christmas break. It was an article by Melody Hobson and John Rogers, how to understand this crazy year in investing and what to do now. I read the article and I was intrigued. Like, wow, they're really saying that the growth track, that means the tech stocks, Apple, Microsoft, Amazon, it's going to come to an end in 2021. We all should be focused on small cap
and value
stocks. Yeah. Very interesting. So I forwarded you the article, and your response was?
Well, first, I love the title, How to Understand This Crazy Year in Investing and What to Do Now. I mean, who wouldn't read that article? My response was, it's a great article. I thought it was well written. They're looking at one aspect of the marketplace where tech and large growth, large tech companies in particular have done so well in 2020, and that was about to end, and that investors who, were reading this article should rotate their portfolio into value-oriented and particularly small value-oriented companies. And I thought, well, that is a unique perspective. So I wanted to learn more about why they had that perspective, and come to find out they are either owners or, work at an investment management company that specializes in small cap value investing.
Which after we dug a little deeper, they really aren't even that good at doing that. Looking at Morningstar ratings and past results, of course.
Well, it goes to show that
asset class has also been beaten up.
It's been terribly beaten up. And so maybe they're saying that this is the time that undervaluations will creep forward, and rise to their fuller valuations. And that's all good and fine. But it's a perspective that they have in the marketplace, almost a bias. I mean, investors simply have bias when they look at their portfolios and they think about the things that they want to invest in, and they gravitate towards those bias. As an investor who's gathering information about the marketplace and trying to determine what's best for themselves, we have to understand that a perspective is not the entirety of the marketplace. It's part of the story.
Right. It's, I guess, more mainstream way of looking at it would be it's media bias, or in this case, author bias, which, okay, so if I'm scrolling through Facebook at 11 o'clock at night and I see something in there that, a news report, we never actually went to the moon. We never landed on the moon. It was a conspiracy. You just keep scrolling and go, yeah, whatever. Right. Or if you see an article about something, you go, that's interesting. In my head, hey, I'm seeing this on social media. It doesn't mean it's true. It's from some publication I've never heard of. I should probably go check it out from a reputable source. But when you open up the Wall Street Journal and you're thinking about investing in a portfolio, I have to admit that my same defense mechanism doesn't kick in. I go, oh, wow, this was published in the journal. It probably has a lot of merit to it. Now, if it's the opinion section, that's a different story. But just as a normal article, this article was sent to me by Wall Street Journal saying, hey, this is a trending article. It was written back in December the 11th, but so many people have viewed it that it keeps resurfacing, right, as a trending article. So to me, it's a reminder that, man, even especially as a professional, when I read the article, I actually have to do a little research on the people who wrote it, right?
I think it's very important.
Because now I look at the article totally differently than how I'd have looked at it the first time I saw it. When I sent it to you, say, hey, this is not what we're thinking right now. Are we going wrong here? I mean, this is a major article.
Well, by understanding, the perspective of the author, we can put it in the right perspective relative to the way we're seeing the marketplace. And there's valid information in the Wall Street Journal article. And I'm glad that the Wall Street Journal is actually giving space to different authors with different perspectives, because you and I can put that together like we're putting together pieces of a puzzle in the same way we put together a portfolio designed to meet a specific objective, and we can either use that information or discard it at any point in time as we see fit.
Well, lesson learned on my part for sure, or lesson reminded maybe, because I'll probably do it again. Going, oh my gosh, this article is totally has a totally different perspective than where we're coming from right now. But it's the same way in our industry. In our industry, we're a fiduciary fee only firm, so we're focused only on what is best for the client, and each client, what's best for them could be different. We're not trying to put everybody into a square box, right?
Right.
Going through my feed, local Edward Jones advisor out there saying, hey, contact me. I can save you hundreds of thousands of dollars in taxes for if you have more than $500,000 in an investment portfolio. Well, I know what that is. That's an annuity sale, right? Because first of all, Edward Jones, last time I checked, doesn't do tax returns. So I don't know how he can say that he can save you $500,000 in tax returns. It's
going to take a long time for him to save all that money.
I know, exactly. A lifetime, really. And then looking at what their agenda is. Their agenda is always product sales. That's how it's built. And I hate to pick on them. They have more aggressive sales tactics than some of the other larger firms out there, and it shows in their when you look up their broker check. A lot of these guys, it shows their aggressive tactics. But the reality is that everyone has an agenda. I hope at this firm, which I control, that we have eliminated the agenda, that the agenda is always only what the client wants. I even tell all the advisors here that when we sit down and talk with a client, it's not about what our objectives are as a company. It's what how can we help the person in front of us? And I hope that comes through. I think it does in our 99% retention rate, 98% client satisfaction rate. But going back to this article, small caps had a great end of the year. Value kind of made a surge a little bit, right?
A little bit.
Did kind of petered out, and the growth funds won the day in the end for 2020. But again, you read the article. We're always looking for ways that we can tweak a core portfolio to get a little outsized returns, I guess.
Well, sure we are. That's part of why our clients come to us and trust us and believe in us to put together a portfolio that gets the maximum return for any given amount of risk that they're willing to take. And sometimes we have to look a little bit outside the box because we're constantly exploring. And we either accept or reject these ideas as they come up through at the office, through articles that we read, through research that we get into, through our associations with other individuals who are in the marketplace, and we bounce ideas off one another. So I think it's important that we constantly are looking for other ways to enhance the returns in our client portfolios without increasing the risk.
So read the articles, but verify the author.
That's right.
Good topic number one. Topic number two, we've been talking about COVID relief part 2. Man, is this thing hard to decipher? We have a industry leader in getting information out very quickly in our business. It's a group that we all, I think, sort of look up to. They have a great media presence. Even their summary was horrible. They were so proud of it. We're launching our summary of COVID Part 2, and it's missing everything that's actually in COVID Part 2. So you had to kind of piecemeal this thing together. But let's talk about it. I think for business owners sitting out there, man, what a great opportunity to entertain clients right now. The entertainment, which is 100%. Well, that actually went away. That's come back, entertainment, and then meals.
Right.
So typically, you either didn't get to deduct it, or it's 50% for on the meal side, and now that's 100%. So I don't know who is going to take people to restaurants at the peak of COVID, but restaurants need our help. Maybe it's an order in, maybe it's ordering for your staff. But you can now get the full deduction for business owners on meals now, where prior we weren't able to do that. Charitable?
On the charitable side, I I think we had talked about this in a previous podcast as well, but in 2020 taxes, the 2020 tax year, you can deduct $300 off your top line, as a charitable deduction, even when you use the standardized deduction, which is key.
Right.
And in going forward for 2021 tax year, I believe they've doubled that to $600. So it's a nice little tax, deduction benefit for people who use the standard deduction, as most people do now.
So that's $600. We've interviewed some great people doing some amazing things in our community. Betsy Kurtz, a few interviews ago, Orrin Checkmate Hudson, doing his teaching in inner city schools with chess, helping young boys and girls learn how to use their resources properly, keep their head in the game.
Right.
I still have all his little rhymes in my head.
Yeah.
What a great guy, and doing what he's doing. Betsy as well. So there's some great organizations out there that are using Wellstar Foundation's another one here locally, that are using 100% of your donation to then turn back around and help people individually. So that's a great opportunity for those people who would normally not get a charitable write-off on their tax return. The other part is, for people who are able to receive the
stimulus payment.
You're not going to have to pay tax on that. I don't think they ever really thought about it, probably, that they'd have to pay tax on that.
But nonetheless, it's that was income that was received that's tax-free from the federal government.
Absolutely. Mm-hmm. Unemployment benefits got extended, which I think is a great thing.
They've increased the amount that the federal government will pay to the unemployed individual on top of what the state pays the unemployed individual. And I agree with you. That is a great thing that it got, continued. Look, this is money that's going directly into the pockets of people who need it the most, people who are unemployed.
Right.
And that money is not going into their checking and savings accounts. That's going to pay the heating bill. That's going to pay the rent. That's going to pay, the grocery bill, the clothing, the schooling, et cetera. So that money is immediately turned around and used until they can find work elsewhere.
Yeah, hopefully things will pick up again, but there's a certain demographic in our country and certain industries in our country that have just been absolutely decimated through the COVID shutdown. And with COVID at all-time high, UK is shut down again right now. My heart goes out to them, and they're just trying to survive at this point.
Yeah, in economic terms, when things evolve and change is considered creative destruction. But in this sense, when we had the economic shutdown, I don't know whether there was much creative part here. There was just the destruction.
Right.
So where the creative part hopefully will come a little bit later. I heard a great analogy. Somebody compared this to a forest fire. Forest fire goes through the forest, burns down everything. A couple years later, you have new trees growing. That's the creativity of it. Question becomes, in this economy, are those going to be new trees or are those going to be old trees regrowing? So we don't know exactly what the creativity in the economy is going to be going forward. So when you mention some industries being decimated, some employees may not be able to return to the same type of work they had before because it simply may not be there. Mm-hmm. This is the part that's unknown going forward, that we don't know exactly what's going to be on the other end of this shutdown when we're completely reopened. And as we go through the reopening process, I think that the vaccinations and the reopening are going to have somewhat of a direct relationship to one another. As more and more people get vaccinated, more and more people will be returned to work. We will return to restaurants. We will return to movie theaters. We'll return to, a little more travel and leisure type activities, which in turn employs more and more people. But what happens when we're back fully? There's still going to be somebody left over.
Right, absolutely. Yeah. It's also, I guess, on the positive side is some entrepreneurs have gotten very creative and they're doing great.
That's what we're counting on.
That's, Chick-fil-A, more revenue than ever before, and yet all their stores are shut down. That's amazing that they're able to adapt so quickly.
Yes. And for the general population to adopt that adaptation by companies is just as amazing.
Right, absolutely.
We were willing to do business in a new manner.
There's an outfit out in Seattle. I wish I could remember the name of the restaurant. Same thing, high-end fine dining restaurant. Started flipping burgers in a tent. People would come by and pick up burgers in a sack, and then they started delivering meals. They had a piano player that would play in the restaurant, and you could zoom in to the piano player playing the music while you were eating your food that was delivered to your house. I mean, just the creativity behind it. The owners admitted that they were still losing money in all this. They were still losing money, and it was hard to keep employees because of the. I honestly said unemployment checks. Unemployment checks were a little too generous, I guess. But he said that that they felt like they were bringing some peace to people in the times of uncertainty. And I thought, man, that's really creative to not, I hate it when people say this happened to me. Well, don't let things happen to you. Make things happen. It's a mindset, right? It's a mindset that, okay, this is going on. I'm going to make sure that this happens. Not that, oh my gosh, I'm worried about this happening to me. Does that make sense? That's what those owners did. The owners took something that was very negative, flipped their company around, and then they actually started raising money for local charities through the whole process as well, which is very interesting.
Well, what's fascinating is that business owners in this manner have been able to reimagine their role in the socioeconomic spectrum here. From people come in, they order a meal, we cook it for them, we serve them, and they pay us and they leave, to we're part of feeding a greater community here. And we're going to gather resources, utilize them, and then redeploy them outward for people who need them. And they became like two ends of the funnel being put together, right?
Right.
And it's fascinating how they reimagine themselves in that instance. And I'm sure there's hundreds, if not thousands, of other stories.
That would be a great book to be written.
It will be.
Perseverance in times of crisis, and different short stories of different business owners. That'd be great. Topic 3, Bitcoin mania, part 2. So I don't believe that we should ever discount something because we don't understand it. It takes a lot more work to go and understand something and learn and educate yourself about something. It's very easy to say, yeah, no, that's not for me, or call it voodoo or something. So on my desk, I have a very thick book about digital currency, blockchain, and Bitcoin because I want to learn everything I need to know about this. What's interesting is the utility of Bitcoin has not really out there yet. If you make a lot of money in it, let's say you put in $10,000 and now it's worth $500,000 because you were an early investor. You can go buy a very expensive sports car with it. And maybe that's worth it to you because you only had $5,000 or $10,000 US in it. But for new purchases of Bitcoin, you could lose your buying power overnight by 15, 20%.
Yes,
right?
If you were planning on using it as a currency to make other purchases, absolutely. But right now, it's a very speculative type of investment for most individuals. Okay? And Bitcoin itself has become kind of the generic term for all the other electronic currencies that are out there.
Hundreds and maybe thousands of them that exist.
Yeah.
So I think that we're moving to an idea that maybe 1% of a portfolio could be in digital currency. Maybe not just Bitcoin. Maybe top 10 or top 5 currencies. There's a lot of things going on that would be covered on a different podcast with Bitcoin. But right now, you should look at it as a speculative investment. Maybe better than the lottery, right?
Better than the lottery,
but not as good as a long-term focus, diversified portfolio and core asset classes or index funds, right?
Right.
So we're still studying the why you would use Bitcoin. It's funny. I talked to a lot of advisors about it, and their response is, well, I own Bitcoin, but no, I would never put that in a portfolio. I was like, well, I mean, I'm really big on you practice what you preach. So if you're going to put Bitcoin out there in your own portfolio, why wouldn't you put it in a client's portfolio? Part of the issue now is the vehicle to do that. The vehicle to put Bitcoin or something similar into a portfolio is very costly. 20% premium versus just getting out there and buying it on your own.
So platforms are evolving for individual investors to buy and sell.
Correct.
These currencies.
But for advisors, we haven't fully evolved yet.
Right.
If you do it, there's a huge premium, and therefore you got to be banking on huge movements upward and the value to make it worthwhile. Mm-hmm. We've demoed at least one platform that would allow us to actually build models of this, but it's so at the beginning, the beta stage, that none of our custodians, be Schwab, Fidelity, TD Ameritrade, are linked to it. So I don't even know how you would fund it because it's not linked to our main custodian, right? So there's a lot of hurdles to be made from the advisor standpoint. But for an individual, I would say tread carefully, and at this point, no more than 1 or 2% of your total net worth should be in the product. Let's topic 4. This one might be a little more passionate today. The day that we're recording this is election day. I keep seeing on social media feeds, vote red, vote blue. I have my reasons for voting the way I vote, but when it comes to the portfolio, honestly, it doesn't really matter. It doesn't really matter. It may matter at some shops that are buying individual securities based on certain political moves. But our shop here, we're built on core Vanguard-like asset classes. That means we're going to own pretty much everything and manage the volatility along the way. And I would say that if today ends up being a Democrat sweep on the ballot sheet in Georgia, that tomorrow we can still wake up and go to Chick-fil-A and get a Chick-fil-A sandwich, and we can still save money and keep working, and everything's going to be fine.
Well, to your point, the fact that we're building our client portfolios using long-term healthy core asset classes, any companies or industries that do well under either scenario, we own in our portfolios. And to the extent that they do well, our clients will participate in that value appreciation. So when using, these types of ETF, core S&P 500, small cap, international, emerging markets, et cetera, it's already in there. All those companies that will do well going forward is part of, the composition of the portfolio already. We don't have to do other research to find out exactly which company it is. Right. Or which industry, and then tilt the portfolio that way, which would create what we talked about earlier, a bias in the portfolio.
Yeah, I just keep seeing on social media, hey, if Republicans don't win this, the stock market's going to tank. And you don't hear that from the Democrat side as much, partially because of their agenda, but and their demographics that are voting. They have statistically less people as focused on the market, but it's kind of an ignorant statement, and so you shouldn't say it and you shouldn't believe it.
I agree. Making portfolio decisions simply on an election in one state is going to be
or
disastrous.
Election in all states. Go back to the presidential election. If Trump doesn't win, the market's going to just fall apart.
Yeah,
we pushed on through the highest we've ever been.
Right.
If you're the CEO of a Fortune 500 company, yeah, you're going to pivot maybe a little bit based on policies, but you also have massive lobbying power to be able to change the agenda to benefit you. We see that all the time.
And we know that business leaders will adapt to whatever environment they find themselves in.
Right.
That's just the way American business operates.
Corporate tax goes to 28%. Is that good? I don't think so. I think it's a bad time to go to 28% right now. But if they did it tomorrow, things adjust.
Right.
right?
That's right.
You just adjust to it. It's not the end of the world. Now, you could argue there's a bigger impact on small businesses, which we don't probably do the best job of monitoring impact to small businesses. I don't think most politicians understand small businesses, to tell you the truth.
Well, on the private side, it's very difficult to gather that sort of information.
Correct.
Yeah.
Correct.
And there's a lot of small private companies out there that are employing 5, 6, 7, 12, however many people that have an immediate effect on, the whims of politicians, it seems like, because decisions hit them the fastest because they generally are at street level.
Right.
Yeah.
And there might be some drama behind this one. The pollsters have been missing it lately, but right now we're showing a very tight elections. But, the most important thing is that people vote, that everyone participates in the process. Don't sit home and complain about the government if you didn't even vote.
I think that's always been my point. It's highly unlikely that we'll know the election result this evening. So it may take a day or two, and we'll just see how people respond.
But to the portfolio tomorrow or next week or whenever we find out the final winner, we just keep trucking along.
We'll be here,
and we adjust for it. We need to take the anxiety out of this and really more focus on our ideals and what we want to see in government and what we want to see government do for us or not do for us. That's really what we should be more focused on, not so much portfolio rate of returns. I think Trump took credit for every up day in the market, and then every down day was somebody else's fault. And I understand maybe why he was doing it, a little grandstanding, but in the end, I don't know that he controlled it that much.
Yeah, that's an awful lot of credit to take for one person.
Yeah. Exactly. Yeah. Final point, which kind of goes along with the election, market volatility. We're going to see some of that going forward, and we've been talking about it here internally. There's going to be some probably massive up days, and there'll be some massive down days as we teeter on these new highs.
I think it's very likely for the remainder of this first quarter that we're going to see some volatility in the marketplace. And it's not just because of the election today or the results, going forward. It's going to, have volatility relative to earnings that are going to be coming out and how well we did in the fourth quarter and how well the GDP number comes out. And in addition, now that the vaccines are out there, how well they're being adopted and how easily they're being administered into the general population. As I mentioned earlier, I think there's probably going to be some correlation, some relationship between the number of people that are vaccinated and the health of the economy going forward and how fast industries and businesses can reemploy people and redeploy their resources. So the volatility really comes from expectations, Casey. And it's kind of interesting that, bringing it to a one-day event such as today, there was a certain expectation of a certain result from today's election. And if that doesn't happen, the markets immediately adjust to that expectation. And that's what causes volatility. So as we go forward into the economy, it will into the year, as expectations are either met or not met by investors, volatility will occur. And over longer term, the more we have greater certainty about the efficacy of the vaccination and how well it's deployed out into the population, we'll have a better idea of the expectation that we can have about how the economy is going to return to normal.
It's going to be an interesting year, and but I think we come out positive on the other side.
I think so too, and we talked about this in a previous podcast about our expectations were. Both you and I see a positive, return for the Dow Jones and the broader S&P 500 for this year. And I think it's good for our clients and good for portfolios. Historically, any time that the market is up over 10% in the last 2 months of the previous year, the next year has been a double-digit return for the markets.
Interesting.
Yeah. All these little tidbits, Investors and baseball fans keep the most statistics
right.
of anybody in the world. Yeah.
All right, Brad. Great conversation as usual. And we'll see you next week on the next podcast.
Sounds great, everyone.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.